Hi, this is Bob Woosley with Frazier Deeter, and this is part of our Untangling the Technical podcast series. And today we've got a really interesting one. We're talking with Mike Whitacre, our international tax partner, and we're going to be talking about the new tax law in the United States and the impact for both domestic and foreign companies. Hi, Mike. How you doing?
Good. How are you doing, Bob?
Good. So before we get started here, tell us a little bit about yourself and what you do at the firm.
So I'm a tax partner, as you mentioned. I have several U.S.-based outbound clients, but I do also quite a bit of work with foreign companies coming into the U.S., and I probably spend 12 to 15 weeks a year over in Europe with meeting with European clients coming into the U.S. and working very closely with our PKF international offices.
So, Mike, from what I understand, this is, obviously this tax law is being discussed a lot, but I've heard it's the most comprehensive law that we've passed in how many years?
Over 30 years since the 1986 Tax Act, yeah. And a big part of the fundamental change is because of the international provisions in the new law.
Yeah, which we've heard a lot about on all the talk shows. And what we're hoping today is you're going to give us a high level viewpoint of it. So maybe we could break it down. The way my mind works, you've got two buckets: the U.S. companies doing business abroad,
right,
and the impact this tax law would impact them, and then international companies making decisions about doing business in the United States, and has this law helped or hurt their decision making process? But let's go with the first one. What's your viewpoint on the impact of this law of U.S. companies that are also doing business abroad?
A lot of the provisions in the new law really relate to C corporations. You need to look at whether you're a C corp or a pass-through partnership or an S corporation or LLC, and it has different impacts on them. But one of the big things is if you've had accumulated foreign earnings overseas, historically that was not taxed until you brought it into the U.S. Mm-hmm. But the first step of this new law is, through the end of 2017, any accumulated earnings is being taxed, and that's actually the first payment of that is due with the company's 2017 tax return. So that's a current issue right now.
People are filing those right now.
Correct.
Yeah. Okay.
Now that you can pay that tax in over 8 years, but it starts right now. But that's step one, is to basically tax the accumulated earnings that have not been brought back into the U.S. And then we moved to this new system called the participation exemption regime, which is similar to what most of the rest of the world does, where going forward, the income you make in your foreign subsidiaries when it comes back into the U.S. is not taxed.
Okay.
So that's a big change, that aspect of it. Mm-hmm. And that's kind of the two big initial steps in the change in the tax law.
So let me make sure I understand.
Sure.
So you got a C corporation that has accumulated taxable income, but it's foreign.
Right.
They've got domestic as well. So this tax law says, okay, enough of that. We're going to tax it. But what did you say? It had 8 years to pay it?
Tax it through the accumulated earnings through 2017.
Okay, and you have your first payments this year, and you have 8 years. This is like an installment
Correct.
payment.
Yeah, you can pay it over 8 years.
And there's no way for a company to get out of that, right?
No.
Okay.
But it's a lower tax rate than standard. It's 15.5% on your cash assets and 8% on your non-cash assets. So it's kind of an inducement, it's a break, but you still have to pay the tax.
Which is a lot of what our clients have been talking about, how this is a really good thing for the United States economy because it repatriates that money back.
It repatriates money back, but I think bigger than that is it allows companies to move that money around into more productive areas. Could be other countries, could be in the U.S., whatever. Before they were hesitant to do that because they had to pay the higher U.S. tax when they brought it back in, and that's all gone now.
So is this the end of tax haven countries?
I think the U.S. would like it to be.
Yeah, that's one of the goals, right?
Yeah, we'll get into that a little bit further as we go along here.
Okay.
Yeah, I think that's one of the goals, absolutely, is to induce people to keep their business in the U.S.
Yeah, which is a good thing.
Yeah.
So you mentioned C corporations. Now you were going to talk about pass-throughs.
If you're a pass-through, which is an S corporation or a partnership or an LLC generally, the participation exemption is really not relevant, does not apply, because you are a pass-through. When you bring the money back in, you're going to get taxed on it.
Right.
Just like, quote unquote, the old days last year. The repatriation aspect is, relevant, because if you're a pass-through owning foreign subs, you're going to be subject to that same tax, except there is an exemption for S corporations that they can essentially avoid paying that tax until they have a significant transaction, which is really like selling the company down the road.
Okay. Yeah, I've heard it. And a lot of people are some people thinking about converting to pass-throughs because of this, or?
Well, if anything, it's probably the opposite. They're probably
way?
looking at going the other way.
Go C corp.
Yeah.
To get the lower rate.
Well, you get the lower rate, and then there's some other aspects that we're going to talk about, I think, in a minute, that pass-throughs don't really benefit from also.
Okay, that's excellent. So, well, tell us, what are the 2 or 3 points you want our listeners to kind of understand about this as it relates to domestic corporations, besides the things we just talked about?
Yeah, well, I think beyond the repatriation, the participation exemption, the two big unusual new regimes out there is, one is called GILTI, Global Intangible Low Taxed Income, and what that essentially says is, we're going to put, if you have offshore foreign subsidiary earnings, we're going to put a minimum tax on that. And even if you don't bring it back in, we're going to put a minimum tax on that. And but essentially what that equates to is, if you're paying 13% tax in your foreign country subsidiary, you'll have this income, but you won't pay any tax because of the foreign tax credit at the end of the day. Okay. But it's and that's kind of the stick approach, back to what we were referring to earlier, where if you have valuable businesses offshore, they're telling you, hey, we're going to tax you put a minimum tax on it, and kind of encourage you to put it back in the U.S.
Yeah.
And the second leg to this is called FDII, or Foreign Derived Intangible Income. And this is the carrot to either keep your business activities in the U.S. or move it back potentially. And what that essentially says is, if you keep it in the U.S., we're going to only charge you a 13.125% tax rate.
Okay.
So if you think about all that, a lot of these companies have, for the last 30 years, have spent a lot of money, a lot of time structuring themselves offshore to reduce their taxes. And essentially what the U.S. is saying is, hey, just keep that here.
Yeah.
And we're only going to charge you 13% on those types of things.
Gives them a real incentive not to take it offshore.
Correct.
And that is FDII.
That's FDII.
FDII is the incentive part, and GILTI.
It's kind of the stick part.
That's the stick. Yeah. Whoever came up with that, that's interesting. So, Mike, we just talked about FDII and GILTI, GILTI, but I've heard about this other thing called BEAT, B-E-A-T. It's kind of an alternative minimum tax calculation for. Could you talk a little bit about that? We've had some questions on that.
Sure. So BEAT stands for Base Erosion Anti-Avoidance Tax. And what that's targeted at is U.S. companies making substantial payments out of the country to related parties. And so this impacts foreign-owned U.S. companies, but it could also impact U.S. companies making payments out to foreign subsidiaries. So basically, it only applies to if the U.S. group has over $500 million of revenue, and these payments equal at least 3% of the group's revenues, and those payments do not include cost of goods sold. So if the U.S. company is buying product from its foreign parent, let's say, that doesn't count. Right. And there's also some transfer pricing payments that are allowed under the rules too. But basically it's an alternative minimum tax, like you said, calculation for U.S. companies. And if they have a lot of these payments going out, you add them back to your taxable income, run a 10% tax rate on it. And if it's higher than your regular tax, then you're going to owe that higher alternative tax.
So BEAT sounds like a mechanism to catch those large payments going out to a related foreign entity.
Correct. Yeah.
Like a royalty payment.
It's to stop stripping earnings out of the
so
U.S.
you're not
in essence.
Undershooting your U.S. income.
Right.
Income tax liability.
Exactly.
Okay, good. That's great.
But let's go back to the pass-throughs for a second here. So the pass-throughs have to pick up this income But just because of the quirks in the law is, for instance, under guilty, they do not get the 10.5% rate. They have to, because that rate is only for C corporations, so they have to pick up that income in the U.S.
Okay.
But the other issue is because it is foreign sourced income, because it was recorded in their foreign subsidiary. They have to pay the full tax rate when, and if as a flow through, that may be 37%.
Okay.
So this little aspect is 10.5% for C corporations and 37% for pass-throughs, and they do not get the 20% qualified business income deduction because it's not domestic income.
Okay. So apparently, I bet companies around the country and your clients, you're running scenarios.
Correct.
You're looking at their foreign and domestic earnings, and you're running, okay, which form of entity should I be? What are the tax impacts here? And,
right.
Yeah. What are some of the strategies that you see they're doing if they get into the bad spot? I mean, what are they?
Well, I think the big takeaway here is that it's not necessarily bad. I mean, the guilty outcome is bad. Let's say for a pass-through because they're paying 37% versus 10.5%.
Okay.
But on FDII, they're paying if they get the 20% qualified business income deduction, they're paying essentially 30%, which is the regular rate. But they don't get the break of the 13% rate, but they're not getting penalized. They're paying the normal rate on that type of income. But I think the big thing that companies need to do, pass-through companies that have a lot of foreign income, should look at, do we need to be a C corporation? Mm-hmm. And that the outcome of that is just totally dependent on the characteristics of that particular company.
And being a C versus a pass-through, that has besides this law, it has other ramifications, like when you sell your company.
Correct.
So you have to take a broad picture. I mean, because C corporation stock may not work as well as a pass-through.
Correct. Right? That's why it may not make sense to convert to a C, even if the tax rate is a lot lower currently.
Yeah.
Because when you sell your company, eventually being a pass-through is usually a substantial benefit.
Yeah, you have to take a lot of different factors.
But companies should look at this just so they understand what's going on, and there may be a reason to switch to a C corp depending on their situation.
So what I hear you saying there is you better look at your situation.
Yeah.
And I mean, look at it in a broader spectrum, not just this tax law, but certainly because of this tax law.
Correct. And I think most or all of this is generally beneficial for C corporations, but if you're a pass-through, you definitely need to look at what's going on and make sure you understand how you're impacted.
You and I were talking before we started recording about foreign companies and their view on this, they may be looking at maybe setting up an operation here in the United States, maybe not.
Right.
Talk to me a little bit about what they were thinking before this tax law and what impact this tax law might have on their decisions.
Okay. I mean, beyond taxes, obviously that's a big economic decision, but I think for the last, several years, foreign companies, have looked very favorable to the U.S. because it's the biggest market in the world. The economy has been growing, probably faster than most of the rest of the world, or at least steadily. Mm-hmm. And that's been enticing to clients, foreign-owned companies. But I think now, because most of them are structured as C corporations, usually they'll benefit from this drop in tax rate from 35 to 21. So for those companies that are on the fence or so, I think this is a big inducement for them to come in and go ahead and set up business in the United States because of that.
So clearly that was one of the goals of the tax law, is by reducing the rates. It provides incentives for you to stay. And we talked about this, the C corps, the domestic C corps and the domestic pass-throughs. Sounds like for pass-throughs really where a lot of hair is.
Yeah.
And then now you have international companies that might have a greater incentive because part of their decision is a lower tax rate.
Right, and that was talked about for years, where the U.S. had the highest tax rate, I think, of all the industrialized nations.
Yeah, so why do business here, right?
Right, and everyone realized that was a competitiveness problem.
Yeah.
So that was a big driver behind trying to get that corporate tax rate down, was to make it more attractive for foreign companies to come into the U.S. or U.S. companies not to move their business out of the U.S. Like you saw several inversions going on in the last 5 or 10 years, that type of thing.
Yeah. Well, this is fascinating. This tax law's got more entanglements than I originally thought. I know we have some published information on our website, www.frazierdeeter.com. And Mike, give us your email address.
My email address is Mike.Whitacre at FrazierDeeter.com, and Whitacre is Whitacre.
Before we finish up, is there anything like unsettled about the law that you're looking for guidance on, or you pretty much know what you need to do with a client right now?
I mean, I think generally people know what they need to do, but because this was such a comprehensive change and it was moved so quickly through Congress to get it done, that there's a lot of devil in the details type of things, and that's what a lot of the tax practitioners are waiting for, to get clarification on the mechanics of a lot of these things. And the IRS is currently putting out notices on a regular basis trying to provide guidance to that. But I think generally, from a big picture, everyone understands what the outcome of the new rules are. It's just it's an implementation issue more than a strategic issue.
So as you're helping clients implement over the next 6, 8, 9 months, or longer, maybe we could ask you to come back, maybe 3 or 4 months from now, and you could tell us some war stories, some real life practical. I know you're in the weeds right now with it. Would that be okay for you to come back?
Sure, glad to come back. Yep.
Okay. Well, great, Mike. Thank you for coming here, and we appreciate it. And thanks to all our listeners.
Thanks, Bob.